Nishal Maheshwari joining us. He is market expert, of course. And Nishal, let's talk about Biocon for a bit because that burgeoning debt number of around 5,000 plus crore, at least at the end of the September quarter, is where it stood. This equity raise should, in some form or shape, help the balance sheet and help the business as well, you reckon? How do you view the QIP positively?
Definitely, I think so. One thing is basically that that debt of 5,000 crores. I think over the next 2 or 3 years, given the cash flows, I think that's going to take care of it. This QIP is largely because the stake they bought out from one of the holders of BBL that needs to be paid, and I think this money will go towards that. So this is for that. And I think as far as the debt is concerned, I think in the next 2 or 3 years, the cash flows are pretty strong for the company.
And within the pharma pack, is Biocon one of the top picks that you have? Also give us the thought process rationale. This is, of course, with regard to cash flow, but in general, how do you see the business evolving?
So I want to make a disclosure. I'm owning Biocon in my portfolio, so that might be a bit of a biasness if I have, if I'm giving you a view. But definitely, I think Biocon with this consolidation and the launches, which is likely to happen in the next 1 to 2 years, it's in a very good sweet spot. And if you really look at it in the last 2 or 3 years, they made a lot of investments, and I think that is going to fructify in the next 2 years. So that's why I continue to remain positive on Biocon. Within the pharma, the bigger space which I like is the CDMO. And that is a space basically which is growing very, very rapidly.
What within CDMO do you like, Nishchal? Any names in particular? Sorry.
So I own Laurus, and that is my top pick basically as far as CDMO space is concerned in pharma.
Okay. Laurus is the pick. All right. Nishal, I wonder if within the asset managers or within the financialization of savings theme, if I can call it, just widen that theme a little bit more. Do you believe that Anand Rathi, which came out with again a decently strong set of numbers, right? That growth with regard to AUM just continues to tick upwards. 1 lakh crore was the guidance given by end of FY26. They've nearly done that at the end of Q3 itself. So they're a quarter ahead. Do you believe that one should feature, or valuations not looking as good?
So I do not track Anand Rathi, so very difficult to say in terms of numbers. But broadly, the space is really very interesting and very good, and a very long runway out there. So one should be invested in that space basically as far as a portfolio is concerned. Now you may take your picks because I think the space is really a long-term play out in the country.
How do you view it, Kunal, from a chart check standpoint? Anand Rathi, it's been a one-way move since the IPO, of course. How is it looking?
See, on the charts, it's looking attractive. The stock has done reasonably well. We've seen good stability coming back. The stock holding on to those key support points. I think the recent low for the stock was around 2,800 mark, if I'm not wrong, in the month of October, November, where the stock bounced back and just come back towards its previous major highs, 3,150, 3,200 levels thereabouts. But it's a stock which is more stable on the price course and doesn't go into major part of volatility or price correction. That's the best part about the charts for Anand Rathi Wealth. So I think for traders who are looking at a buy, 2,800 levels is a good support point. The closer you are towards the support, the better the risk reward.
Okay. And since we're on away from large caps, that is, Kunal, any stock specific ideas from within mid caps?
Yeah, I think from the mid cap arena, I would look at L&T Finance. So the stock which had done fabulously well for the entire calendar year 2025, now gone into a mild correction, has come back sub the 300 levels. So I think closer to 295 odd levels is where I would suggest a buy on L&T Finance for a target of 310, stop loss at 290.
Okay, let's tell you what else has been making headlines. And as the nationwide protests rock Iran, the rhetoric from Tehran is turning sharper. While Trump claims Iran is ready to negotiate, Iran's Foreign Minister Abbas Araghchi says that talks are possible only on the basis of mutual respect. Also, US banks are warning consumers that they could be hurt by Trump's proposal to cap credit card interest rates at 10% for a year. Financial groups say that the move could restrict credit access, especially for subprime borrowers, and trigger higher fee, fewer rewards and tighter limits. Also, Alphabet briefly crossed the $4 trillion market valuation, becoming the fourth company to ever hit that milestone, as renewed confidence in its AI strategy lifted investor sentiment. Shares jumped after Alphabet said that Apple's next-generation AI models will run on Google's Gemini. And Paramount has sued Warner Brothers and its CEO after the board again urged shareholders to reject its hostile bid for $30 per share. Paramount has also flagged a proxy fight days after Warner agreed to sell HBO Max and its film studio to Netflix. And back home, it's the last day of campaigning for the high-voltage BMC polls. All parties are leaving no stone unturned as they push through the final lap before Mumbai votes on January 15th. The Thackeray brothers are fighting the polls together, while the Mahayuti has already won 68 seats uncontested.
All right, big board brokerage this morning. CLSA on HDFC Bank. Let's see what the view is from CLSA. Meryl, what are you catching?
Well, yes, CLSA have maintained their outperform rating along with a target price of over 1,200 rupees, implying a 28% upside from their current levels. Let's see why. Firstly, they've said that investor concerns that were floating around are about slower deposit growth and a lack of margin improvement post-merger are largely misconceived and are temporary. So as per CLSA, their FY27 valuation, the FY27 for the bank, for HDFC, is expected to be a bounce back year. This is because its valuations are now standing at a 10 to 12% discount, a price to book discount as compared to the likes of ICICI Bank. They've also mentioned that cost discipline in HDFC Bank has been seen to be improving, with their core operating expenses growing at 5 to 7% year on year, while the loan growth grows at 10% year on year. They've also mentioned that OPEX is expected to consistently lag loan growth, which is always a good sign. And they've also slowed down hiring and are redeploying employees currently to more customer-facing roles. They've also mentioned that core pre-provision operating profit is expected to grow at a rate of high teens levels over the next 2 years. But apart from this, their ROE is actually lower than ICICI Bank, which actually justifies some of their discount. But at a 1.7 times FY28 price to book ratio, CLSA is seeing a high risk reward and is seeing this as extremely favorable. Hence, they have maintained their outperform rating along with an almost 28% upside for the bank.
Right, okay, that's CLSA on HDFC Bank, but on to an ET Now exclusive, and we've learned from our sources that the government is exploring some options to ensure stable fund flow in the market. In fact, my colleague Prakash Priyadarshi joins in with more details on the same.
Well, the government is likely to announce some measures to ensure stable fund flow in the market. Sources indicate that some measures are being explored to enhance foreign portfolio inflows. We're given to understand that the government is exploring options to provide tax-free status for listed equity investments by long-term pension and endowment funds. These funds are enjoying tax exemption in their home jurisdictions, and therefore government is exploring similar kind of options. Some other measures are also on the table. In fact, currently pension funds and sovereign wealth funds benefit from tax exemption under Section 1023 FE of the Income Tax Act 1961. In addition to that, sources are suggesting that the discussions are underway on some other measures as well. In fact, some measures have been suggested by the industry during course of discussion, especially during pre-budget consultation with the finance minister. The industry has urged lowering STT on cash market trades as compared to derivatives. In fact, these suggestions are being actively considered by the government. However, final decision has not been taken. Sources suggest that the government will take final decision closer to the budget. But the good thing is that the government is actively considering this proposal.
Okay, in fact, let's mark some of these rates and see how the pre-open rates are absorbing the likes of TCS as well as HCL Technologies. And what is it that we're seeing on the likes of an HDFC Bank, which really got battered all through last week, or for that matter, even Reliance Industries? And one can see some green, at least on the tech names, along with HDFC Bank, which is also holding up almost 1% as we speak right now. But Nishal, curious to get your views in on HDFC Bank. Interesting note coming in from CLSA. While they maintain they outperform and the target price is 1200, but we've seen how HDFC Bank as well succumbed to the market volatility all through last week.
So I do agree that it is very attractively priced, and this basically I think the valuation, and given that it is now the merger blues are behind it basically. So I think it's a attractively priced stock at the moment. But then are so others also basically. So an ICICI Bank comparatively in the next 1 or 2 quarters, that is also not done much in the last 1 or 2 years, in the last 2 or 3 quarters. So I think that way you have to calibrate it, but it's a good trading bet at these prices.
But if you had to just pick one lot, would it be PSU banks or would it be these giant private names?
So if you are looking in the short term, it will be PSU banks. There's no doubt about that. And if you are looking for a medium term kind of a thing, then I would go for a private banks.
Sure. Kunal, what's your bias? Because time and again, we've talked about all through last year, at least, whether PSBs is a more lucrative trade as opposed to private banks. And clearly PSBs won. Will that trade continue to benefit?
See, I think that was a trade for 2025 second half specifically, where PSU banking stocks outperformed by a huge margin the private sector banking names. Now, I think it's time to be a little bit more balanced. So if, for example, the earlier skew was maybe 75% more tilt towards the PSU banking names, 25% to the private sector banking stocks, I think it's a good time to now balance it out, make it 50-50, if not slight higher to the private sector banking names, because there's bound to be a point where these large cap private sector banking stocks are going to a phase of an covering up or a catching up of the underperformance. And I strongly believe that the likes of Axis Bank, Kotak Bank, HDFC Bank, even ICICI Bank to a larger extent, I think somewhere down the line, these stocks will try and play a strong catch up for themselves. And I think if that happens, there could be a huge margin where these stocks may cover up the underperformance with respect to the PS banking names. And I think in that sense also we may expect at least an 8%, 10% kind of a strong move which could happen for many of these private sector banking names. So I think I would probably now look at more of a balanced approach over here rather than a bit of a skew which was there in maybe the fag end of 2025.
Okay. And would you therefore play through the Nifty Bank or would you play through the individual names?
See, if you're betting on Nifty Bank, you're betting on all the stocks at the same equal proportion. But the other way is, if you are looking at specific underperformance from those large cap private sector banking names, then you focus there on these few large cap stocks. Axis Bank, for example, is one of the stronger ones run on a relative basis. Kotak Bank is number 2. ICICI Bank, after this last 70-80 point recovery for the stock, I think now comes back into number 3 in terms of the relative strength on the price performance basis.
Nishal, other than that, where is it that you're finding sectoral comfort right now? Consensus seems to be hinting towards both metals as well as autos. Is that your preferred bet as well?
So I would be positive on metals as yet, basically, because I think that trade has not played out as yet fully. So there is some scope as far as metals is concerned. So I think there is a broad trend across the world of owning assets. And I think that's why you are seeing that metals are doing well. I would also look at some of the other sectors also, especially power. The stocks have corrected quite a bit, and I don't think so. Basically, it is clear that whether the Chinese companies are going to actually be allowed or not for all the whole gamut of operations, but the stocks have corrected quite a bit. So I think that's another sector. Basically, one can look at some of these stocks.
Interesting. Wonder within power, Nishchal, would you look at the renewables? Would you look at the power financiers? Where within the power supply chain would you play?
So the EPC players are the top guys, basically, I would say. They are not going to be directly impacted by any of this. Rather, if the supplies get, or if Chinese companies are allowed, some of the products which they are paying by importing from France and Italy, I think that is going to become cheaper. So I would play the EPC guys because I think they are placed much better than anybody else. And then secondly, it would be the equipment suppliers. And third, maybe financiers. But financiers is like anything, basically like a bank. I would actually play banks more than the financiers.
Okay, Nishal, great to have you on the show. We'll let you go on that note, just counting down to the market open. And let's see what's actually holding up. Yesterday, of course, there was a big spurt in Asian